Imagine it's the year 2045. Two friends are sitting in the same coffee shop. Both started investing at age 25. Both earned similar salaries. Both invested $500 every month. Yet one of them is financially free. The other is still worried about money, still checking bills, still wondering what went wrong. The shocking part? The difference wasn't how much they invested. The difference was how they invested. ETFs, or individual stocks. And if you're investing today, this one decision could impact your future more than almost anything else. Let's start with what most people do. They hear a success story. Someone bought Tesla early. Someone made a fortune with Nvidia. Someone turned a small investment into life-changing wealth. And suddenly, everyone starts searching for the next big winner, the next stock, the next opportunity, the next shortcut to wealth. It feels exciting, but excitement can be expensive. Because every time you buy a single stock, you're making a bet that one company will succeed. And sometimes it works, but sometimes it doesn't. One bad decision, one unexpected crash, one struggling company, and years of progress can disappear. Now let's talk about ETFs. An ETF works differently. Instead of buying one company, you buy hundreds, sometimes even thousands. Technology companies, healthcare companies, energy companies, financial companies, all at once. Think of it this way. Buying a single stock is like betting on one horse in a race. Buying an ETF is like owning the entire racetrack. If one company struggles, others can keep moving forward. And that's why ETFs are often considered one of the simplest ways to build long-term wealth. But here's the secret. Most people never hear. The stock picker is trying to beat the market. The ETF investor is becoming the market. Read that again. While one investor spends years trying to predict the future, the other owns a piece of whatever future wins, whether it's AI, technology, healthcare, or industries that don't even exist yet. That's the power of diversification. Now imagine two investors. One starts buying ETFs at age 25. The other spends years chasing hot stocks, jumping from trend to trend, following headlines, following hype, following fear. 20 years later, the ETF investor may not have exciting stories, no overnight success, no viral stock picks, but they have something better: wealth. Because investing isn't about being right once. It's about avoiding being wrong over and over again. That's a lesson many investors learn too late. So, ETF or stocks? If you love researching businesses, studying financial reports, and accepting higher risk, individual stocks can be rewarding. But if your goal is simple, build wealth, reduce stress, and let compound growth work for decades, ETFs are often the smarter starting point. Because financial freedom rarely comes from finding one perfect stock. It comes from consistency, patience, and staying invested when others quit. 20 years from now, you probably won't remember today's stock predictions, but you'll definitely remember whether you started investing. Because the biggest risk isn't choosing the wrong investment, it's spending years waiting to make one. Choose wisely.